biggest thing to follow is the companies themselves. The trap that most people fall into is that they start reading the newspaper and letting the headlines guide where they invest. The parallel we draw is that it's sort of like, the people always want the Lamborghini, the fastest car on the road. But when you're on the fastest car, as soon as you hit a corner, you can easily go off the road. And that's exactly what we've seen last year with India, China, Brazil. Both of, all three markets are down almost 50% year to date. And we've seen the same with commodities just recently, with the TSX being down 12% just in September alone. So you have to get away from the newspapers and focus on the actual companies and what they represent. Initially, for somebody getting into the investment field to find them is actually start looking at some of the mutual funds and look at their top holdings. Like there are some bright people who work in the industry, so that you can look at Warren Buffett's holdings. Why does he hold what he holds, and start to understand how those companies work, and that will give you an idea of the types of investments that you want to be involved in. The thing you've always got to shy away from or be careful of is looking for the big kill, because everybody thinks, okay, well, all I can do is I'm going to be the investor in Microsoft in 1985. Now the problem with that is that there are a lot of Microsoft wannabes have been left by the roadside, and Microsoft was the one survivor, and you can end up losing all your money trying to find the one sure thing. What you want to do is you want to find good, solid investments that over time compound and pay off for you. The one thing to remember at the TSX is that it's not an investment portfolio. It's heavily, heavily concentrated in three areas. It's 30% financials, another 30% in energy, and 15% in materials, the bulk of which is gold. So basically you've got a big play on commodities and financials. So we've seen with crude oil coming off and all commodities coming off that the TSX has followed suit, has come down heavily, heavily, heavily. So that as it's going up, it's great because you're riding the commodity wave, but on the way down, you lose money very, very quickly. And that's where what you want to avoid are big losses. What you want to do is you want to have small investments in a number of different stocks, so 2-3% of your portfolio in stocks that don't all move together in the same direction. So you don't have 30 energy stocks in your portfolio. Have 30 stocks, but from different sectors. So you have some financials, some energy, some industrials, some consumer discretionary, but not all in one direction. It's interesting long term, but it's very difficult to analyze is something like biotech, because you look at all the different little companies that are involved in biotech, and you know that biotech is going to pay, but how do you find the one that actually is going to do well? Because often you'll see these stocks, they do very well, and then the phase 3 trials fall, and then they immediately fall off a cliff. So what you want to do with something like that is you buy a whole group of them through a biotech exchange traded fund. So through that vehicle, you own pieces of each one, so that you capitalize on the broad move in biotech, but you're not exposed to the volatility in any one particular name. It's very difficult to analyze, and it's very much a crapshoot.